Okay, Brian. So once again, thank you for joining with me. I love creating things like this with somebody of your level, your caliber, and I'm just so honored that you give me your time. I still have an issue calling you Brian and not Mr. Hale, but that's okay, right?
It's all right. Mr. Hale's my dad, so let's just stick with Brian.
Someday I'll get used to that. So thank you again for giving us your time. What I really want to share with the audience today is a few key points, but I want to talk about mindset. Where do you feel like this industry is going? I want you to talk about adapting, and there's a very good metaphor, a story behind that. But first, what I want to address with you is the mindset in this business right now. Before, in 2020 and even before that, things were much more of a no-brainer. So 2-something, 3-something% down payment assistance, housing being, more affordable than it is now. What do you think the mindset needs to be around this? Because I just heard the other day, poor people focus on price and rich people focus on the overall value of it, like the generational wealth versus the interest rate. So can you speak to that a little bit, like about where we need to be headspace wise in this market?
Yeah. So, look, a couple of comments I guess I would make around that. To the comment about poor people and rich people, the difference typically between poor people and rich people is that the rich people have the time to think about the context of the overall value, right? Where poor, I don't know if it's poor people, I would say low to moderate income, even middle America, their primary consideration of buying a house is shelter, right? They want a place to live, put their stuff, park their cars, do those kinds of things, safety, schools, good schools for their kids, right? Those are the considerations, which, maybe you're familiar with Maslow's hierarchy of needs, right? Until you can't get to the higher level of needs until you satisfy the basic level of needs, food, shelter, water, right? Income, those kinds of things. And so maybe to some degree, I buy that comment in terms of how those two groups of people maybe think about housing. But here's the real deal. The truth is there's no shortage of demand for housing today. There is clearly a shortage of inventory. And so as a result, there's a shortage of transactions, right? As compared to previous years, previous markets, certainly 20 and 21 were complete aberrations to the marketplace, right? It created just an immense amount of problem. Real estate values have shot through the roof in virtually every market in the country. So you have a combination of house prices are materially higher, in some cases 40, 50, 60, 70, 100% higher than they were just 2 years ago, 3 years ago in terms of property values for the buyer. And then second to that, add what, we just touched over 8% on interest rates. Now we're back down into the low to mid sevens, right? But that's still on a relativity basis. My newsletter comes out every Monday, and we just talked about this in my newsletter today. So on a relative basis, interest rates are up more than 2 times what they were in early 21, right, through the process. So 2 years later, here we sit. Property values have gone up massively. Real estate or mortgage interest rates have gone up massively. It's my general view that most Americans likely could not qualify in many cases to buy the house they're living in today, right, because the property value went up. Now, that said, there's still going to be 4 million transactions this year, purchase transactions in the U.S., maybe a little under 4 million, which by the way is a pretty low number compared to, historical norms.
Yeah.
But it's still, call it 3.8 to 4 million transactions this year. So at every market, there are transactions available. The reality is, of course, that there's a lot fewer originators. Oh, by the way, just as a reminder to everybody, we're in license renewal period, right? I actually have a son who runs licensing for a mortgage company. So he's in the middle of renewal hell right now, right? He's got to get all of the branches and the company offices and all the originators relicensed for 2024. I think you're going to see a huge drop. You've already seen about 85,000 originators go away out of the industry, meaning these were originators who were licensed and actually did a transaction in the last 12 months. About 80,000 have gone away in the last 12 to 18 months. And now you're sitting at renewal season. Somebody has to decide to write the check to renew their license. And if they're doing zero volume, or they've moved on to a career as a bartender, or they moved into some other industry, or they're selling in some other industry, they're a lot less likely to renew that license. My own view is we could see 20 to 30,000 fewer originators. By the way, this is not the uplifting part of today's conversation, right? But the reality is for the true pros like yourself and many of your students that are, working through your courses, the reality is that you're going to have an opportunity to be originating loans where there's great demand, fantastic demographics coming at us. Rates will eventually moderate and come back down. And there's going to be a lot fewer people calling on your referral sources or using whatever marketing methods, digital marketing, whatever the case that you may be using. So you've got less competition. We know there's going to be fewer companies because there's a bunch of M&A deals that have been announced. And I think there's going to be some really big ones announced here before year end, because that's when deals get done, is at the end of a fiscal year. You're going to see some deals get done that I think might shock the industry. Fewer lenders, fewer originators. And then as rates, they've moderated here in the last 2 weeks, but as rates continue to go down, and I think 2024, you're going to see rates slowly, maybe rapidly at some point, begin to really descend. So you're going to have a rush of listings, of sellers, of buyers, the affordability index, right? The sales price plus the mortgage rate will moderate, and you're going to see an explosion in business with a lot less competition. So in short, there are transactions to be had today, and the future continues to look brighter and brighter for true pros who are investing in themselves, building out their business, and going forward on that basis.
Oh, I love it. I can't wait for those days. And you've been such a great predictor of so many things. So this is just the highlight of my year, because you told me in July, hopefully we got, about 12 more months before we see the light at the end of the tunnel, but 2024 is going to be amazing. And I remember you said that, and I'm just marking off the calendar months every single time. I flip the calendar page. I'm like, yes, we're one step closer. But
if I could predict interest rates with great certainty, I'd probably be doing a different job today, right? I'd be living on some Caribbean island predicting interest rates, clipping coupons. But in truth, rates are going to come down. Goldman Sachs came out in an article here in Fortune just the last couple of days and suggests that we could see 3 big interest rate reductions by the Fed next year. Now, that's on the short end of the credit yield curve, but the long end is already suggesting that we've maybe seen the peak, that maybe the Fed is done, because we've seen this downslide of 60, 65 basis points in rate in the last couple of weeks. That's the long end bond investors telling you, absent some disaster, the Middle East conflict explodes much broader, which threatens the flow of oil. Interestingly enough, we have a ground war going on in the Middle East, and oil prices have not shot through the roof. And a big part of that is there's diminished demand around the world that's moderating oil prices. If oil prices were to shoot up or double because there's some fear, then that could impact inflation and could keep rates higher than they otherwise would be. But that's true. That's true about Ukraine. That's true about the Middle East. That's true of another pandemic. That's true of what are generally referred to as black swan events, right? Where things are low probability, but if they happen, they could be very material impact to our markets. In truth, if the war were to break out more broadly, I actually believe rates might come down, not because oil will be a lagging impact, but people around the world will invest in U.S. bonds as a security, as a flight to safety. And that would generally improve our rates, right? That's what happened during the pandemic. People said, okay, I'm not clear what's going to go on in the world. I'm going to put my money in the safest place. That's U.S. Treasuries and U.S. debt. Brought our rates down to historically ridiculously low levels. So,
wow. So when that time comes, I know it's going to happen. We all know sellers are going to start selling. The people that were waiting and analysis paralysis, and they felt like they missed the boat, they're going to come running. Lenders, there's going to be 100,000 less lenders that are licensed. So that's all good. So right now, who's buying? Who's buying the houses right now? I've done some research myself, and I want to know what your opinion on who are these people that are able to afford it? What age group are they? How much money are they putting down? Where are they getting the money? Can you speak to that a little bit?
Sure. Let's start with the part that our industry and you personally and your students and clients cannot participate in. About 35% over the last couple of months have been cash transactions, right? There's something else going on along the side here, which is an immense generational transference of wealth from people my age. So I'm a baby boomer. I'm in my late 60s, right? So generational wealth is transferring to boomers' kids. Equity in real estate. Boomers are selling their house and downsizing. So that's one group that's buying, but typically they buy with cash because they got a whole bunch of equity. Maybe they own their house free and clear in Minnesota and they want to live in Florida or Scottsdale. Well, they sell the house in Minnesota, they show up with a bunch of equity, they pay cash, and they're off and running. The second group of cash buyers is Wall Street. Wall Street is still buying immense numbers of houses on the rental pool basis, right? Where they buy tens of thousands of houses and rent them out, single-family rentals, and then they securitize or they sell those companies to make a killing. We just saw Lennar, the biggest builder in the country, sell 5,000 homes to Blackstone, the big private equity group, in one transaction, right? So think if you're Lennar, you sell 5,000 homes, 48-hour close, all cash, right? So those home sales are in the 4 million sales, right, for the year. So there's about today, depending on the market, 20 to 35% of the market is off the market in terms of being able to chance to do a mortgage because it's a cash transaction. Second big group of buyers are the Gen X, Millennial, and early Gen Zs who maybe are getting a gift from mom and dad or are very well employed, have, good, strong earnings. Maybe they formed a family, right? They get married or, significant other in some structure combination, and maybe they have a kid. In truth, the generations that followed the baby boomers are slower to get married, slower to form families, slower to have kids. They delay for, a zillion good reasons and maybe some other not so good reason. But eventually, when they get married or they form some form of union and then they have a kid, now they think, wait a minute, living in a cool condo next to where I can pub crawl till 2:00 in the morning is less exciting when you have a 3-month-old, right? And so that group is then thinking about, wait a minute, I've got to not only buy shelter, but I got to think about it in a way that I got to look at the schools. I got to have quality schools. I got to be low crime. I got to all the same considerations that boomers had, just later in the process. Now they want a different kind of property. I'm not sure as the boomers downsize and think about different ways of living as they move into their later years. Many of the houses that boomers have are not what millennials or Gen Zers want to buy, right? A lot of them are chopped up. The millennials tend to really like open floor plans, very green homes, energy-wise, those kinds of things. So the builders are killing it on that side. But I think eventually this will sort itself out. So it's people that have to move, corporate relocations. I just was helping a friend in my neighborhood, relocated here from Canada. He's a executive for a big tech company on the West Coast. He's got to go buy a house. He's out buying a house. He just got a 6 7/8, 7/1 arm from a lender you would know well. And, for $1.8 million mortgage, off and running. And so that guy has been living in an apartment, had to buy a house, has kids, has a wife, all the things we want to do in life. Doesn't want to live in an apartment because he's lived in a home, for the last 25 years. So people that have to buy, people who are forming families and or having kids, corporate relocation are buying. And the truth is, some people just want to own a home, right, in the process. And if you as an originator can help them figure out how to do a buy down, how to do a permanent buy down, how to, product selection, all those things, there's still a fair amount of demand because you're seeing homes, look, I live in a pretty nice neighborhood. We have a neighbor about 2 streets up, put their house on the market, 48 hours, boom, gone. Mid 7-figure sales price, gone, right, in the process. And so the demand is there. There's not enough inventory to have enough transactions to go around. That's really the big issue we have. So that's who's buying. Cash, assistance from mom and dad, assistance from the boomers, got 2 good incomes, want to buy a house, want to get in. And as you know, a lot of people today that are buying see getting the mortgage they're buying today as essentially an acquisition tool. And then we'll refinance it later, right? So I'll take a 7/1 or I'll take a 30-year fixed or I'll take a 5/1 or I'll take a temporary buy down now. And then hopefully in the next 2 or 3 years, rates come down, I'll refinance out. Now I've enjoyed the equity and the tax benefits of home ownership. And I got in. Look, There's a lot of debate as to whether if rates come down, do sales prices come down, maybe for a short period of time. But here's what you know. When I was an originator in the early 80s, my average loan amount was $55,000 because sales prices in New Hampshire, very first house I bought, I think I paid $65,000 for it. That house just sold for $1.3 million. Same house, same neighborhood, right? All good. And so my point being is that real estate values over the next 5 years, 10 years, 15 years, 20 years, if you're a homeowner, you're creating more wealth than if you're not. It's that simple, right? There's some folks on the internet who go, oh, don't buy a house, invest your money in commercial real estate, money, improving assets. Cool. Some folks will buy that program and maybe it's right, but most of America needs a place to live, place to raise their kids, safe schools, crime-free neighborhoods, those kinds of things. That's not going to change. And those values, while they may go up or down over short periods of time, long-term, you're going to have more equity in your life if you own real estate than if you don't.
It's always, if I look at my 401k, my IRAs, of course I like to have a little bit of everywhere, but my house in the last 5 years has gone up 10, 11, 12 times more than my 401k could even possibly, and I max it out. So I think that where I see, and tell me if you agree, where I see a lot of people fall short over the years, I've been doing this for 20 something years, it's the hesitation. It's them saying, you know what, it's Christmas, it's December, I'll just wait until spring. I'll just wait until January. You know what, I'm going to wait for 2 something percent, 3 something percent's not good enough, right? And it just keeps going and going. Or even a little bit of like being stubborn so the people that say, I don't want to give free rent back. I don't want to waive this contingency, or they get a little bit hard-headed, and this is not the market to do that, right? Would you agree?
It's not. Well, first of all, I think hard-headedness is generally not an endearing trait. I don't care what else you're doing, right? So now thoughtfulness makes sense, right? You should do the math. You should talk to someone like you. What I did for my friend who came here from Canada, he doesn't even understand the U.S. mortgage market, right? In Canada, there's no such thing as fixed rate loans.
Yeah.
Right. So I sat with him over coffee one day personally and educated him on kind of how it works here, how the real estate business works, how the mortgage business works. And then I hooked him up to one of the top 1 or 2 realtors in Orange County, California that I got through one of my clients. And then I hooked him up to a killer originator that works for a big bank that happens to be his private bank. But I knew the originator, and everybody who runs that mortgage operation at that bank used to work for me. So I called those folks up and said, all right, who's somebody that this guy can and should trust, right? Hooked him up to that person. They did a fabulous job. And part of this is, thoughtfulness is education, understanding how things work, understanding the math and the economics and what should you be charged, all those kinds of things. So that's prudent. That's not a stutter step to me. That's prudence. Where I think, and it used to happen to me all the time, and I've still talked to people that go, I could have they quoted me 7.5, and I'm not moving until I get 7 3/8. And I'm like, oh my God, calculate what the difference is after tax of a difference of 1/4 in interest rate. It's nothing versus the equity you will build in that home, owning it sooner than later, and the tax advantages of homeownership and all those things, right? And so it's, to your point, stutter stepping and finding it. It's what I used to call finding all the reasons not to act.
Yes.
Right? You can always find those reasons. Here's a good thought. Talk to your friends at work. Talk to other people. Talk to somebody who had a disaster in real estate in their lives. They'll give you 27 reasons don't buy. Except, go ask people who have made a killing in real estate their whole lives or have owned homes through their lives. Do they believe are wealthier today as a result of owning a home over time or not? And the answer, of course, is yes. With rare exception.
It's
rare exception. Remember, you and I suffered through 07, 08, 09, and 10, right? Real estate values, particularly in 4 key states, dropped 30, 40%. You go back and look at the values today from someone who bought one of those houses, sustained the drop in value to where the value of that house is today, it could be 2 or 3 times. So yes, there was a 3-month or 3-year dip which caused immense dislocation. But if you bought the house in 07 and you sell that house in 2027, in almost every market in America, you will like the outcome.
Yeah. Yes.
You're in some suburb of Omaha, Nebraska, or, you're some other place. The just truth is values tend to go up. One, because population goes up. The U.S. is underbuilt by about 4 or 5 million homes. We're 4 or 5 million homes short. What happens with shortage when there's demand? The value of the thing that as a shortage goes up, right?
Yes.
So there's almost no compelling reason not to buy unless you believe you have a really unstable job, right, where you could end up in foreclosure. You're buying in way over your head. I think that's malpractice in our business, in my view.
Yes.
When you put somebody into a house where with 40 or 50% certainty, you know it's a foreclosure waiting to happen, that's predatory, in my view, right? And so, there's a good rule. Don't do dumb things.
Don't do
There's this guy I follow on LinkedIn. He's really smart sales guy. And he calls it in sales, don't be in the let's do dumb things faster. It's just not helpful.
Yes. The times where I've been the most successful is when I saw an opportunity and I didn't hesitate. And the times where I made the biggest mistakes is I wasn't willing to get uncomfortable. Prior to 2008, I was 20 something years old and I had 8 houses and I gave myself some NAGAM loans. I was a mortgage lender back then we were being, told certain things or I learned certain things or whatever that was. But there was some houses that I should have hung on to, and I had a BMW for like a $1,300 a month car payment, and I wasn't willing to let go of that car because I loved it, but I was willing to let go of a house. So I wasn't willing to drive around a beater car, for lack of better words, and keep one of my houses. That house, to your point, in 2007, I think we had a short sale up for 400 something thousand. It's going for like 1.1 million now. So that BMW would have been a piece of, by now, what was I thinking? So I really stress to the audience and every client I come in contact with, the lenders that I coach, you got to get uncomfortable. You can't hesitate. Got to make smart decisions, to your point, but you can't hesitate. The people that sit around, they wait for the best opportunity and this perfect thing and the perfect rate, it's just going to put you in analysis paralysis mode and your mindset's not on the right track. And so you're going to lose out. I believe there's a deal in every market for buyers, right? Especially during November, December. Most sellers, you can tell me if you agree or not, are selling not because they want to, because they love this time of year. It's because they have to. My best real estate investments have been when I see open house December 22nd and everyone else is wrapping presents and drinking and going having fun. I'm buying that house because that's when I can negotiate the best deal. Right. And as lenders, the people that say, I'm going to wait and, accomplish my goals and set out for my goals in January, I do my best work. And I do my best work with my students when we sit down December 15th to the 31st, when everyone else is, again, wrapping presents, and we start working on our January and our February plans, and we start working on that 12-week year. People who think this year I'm going to kill it. No, by March 31st, I'm going to kill it and I'm going to start in December. Right? So there's so much about the mindset, adapting to this time. And I want you to tell me your T-Rex story too, by the way. So do you agree that's like the people that just wait, lenders as well, real estate agents as well, to crush their 2024 goals? We can start now, right? We just have to make sure we control our mind.
Look, if you run a company, as I have a number of times in my life, the planning cycle starts in August for the next year.
I like that even more. Yes.
Right? Because, look, you can jam it all at the end. And the one thing I've done most of my life, with rare exception, I've never worked ever between Christmas and New Year's, ever. And it used to be because of family and we'd go do something, we go skiing, we do whatever, when we had kids and at home, that kind of thing. But also I took that time to longhand write out my own personal goals for the next year, next 5 years, next 10 years. Now, did I hit every one of those goals? Hell no. Right? But I can just assure you, the likelihood of you hitting some of those goals is dramatically improved if you sit down and kind of write them out and you can recite them to yourself in your head in terms of what you're trying to get done. And it's not just the goals. Look, I have a goal. I'd like to be 11'5" tall and better looking. I've had that goal every year for a number of years. It just hasn't really worked out for me. I'm the perfect weight if I was 11'5". And so that doesn't work for me.
Like guys.
But here's what I can tell you. The stuff, if you sit down and say, look, I think I want to make X. Right? When I was an originator, I used to do this. I used to do it with my originators that worked for me. Just sit down and coach them. When I was a branch manager, what do you want to make? Right? What do you want to make next year? Okay. How many loans is that? What's your average commission per loan? Let's work backwards. What's your pull-through rate on apps that you take and leads that you get? let's work back. How many referral sources do you need to drive that number of leads, to have a reasonable pull through, to get those loans closed? When I got hired in the business, I had the good fortune to not know any better because I was, green. I was a trainee. And my boss gave me this sheet, and I don't know if I can recite it all, but it was written down in this like sequential goals. Your goal is to take one app a day. So on a typical work month, 21 days, 21 apps a day means 18 fundings a month, means ba-boom, ba-boom, ba-boom. In order to accomplish that, I had to make at least 40 sales calls a week. I had to have at least 2 sales meetings. I had to do some kind of lunch and learn or, seminar, right? Once a week. Ba-boom, 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 ba-boom. And at the bottom it said, and if you do all of that, that's making it as a loan officer. So whatever that equation is for you, that's what you have to be able to remit and understand what are the steps it takes to have the success you desire. And then there's one really important aspect of that. You and I have talked about this before. I had this great saying that I used to have hanging over the door of my office when I was a branch manager, and it hangs in my office at home now. And there's a great old saying that says that everybody wants to go to heaven, but nobody wants to die.
I love
right?
it. Mm-hmm.
People want things in life. Are you willing to pay the price? And I would tell you this, I don't know if you and I agree on this or we disagree on this. I'm like a lot older than you, so I'll weigh in with some life experience here. I don't think you can do it all. I don't think you can have it all. I think you have to trade. You talked about, you wanted the BMW more than you wanted to hang on to that house. In retrospect, wasn't a good call. Right? Seemed right at the time. You were pretty cool, fabulous looking lady driving around in a cool BMW. Life is good. Serves the ego. It's all good. You'd rather have the $1 million in equity in that house today as opposed to that old BMW that is somewhere in a junkyard, right? It didn't work out for you. Yep. And so the reality is this concept of paying a price. And look, I can assure you, both my wife and my ex-wife, 40 years ago, could tell you that I didn't get it all right. Early in my career, I worked too much. Foolishly, like 40 hours a day, literally. I'd go to work. I'd work 40 straight hours, go home, shower up another suit on, go back to work. Not smart. Impacted my health, did a lot of things. But if I had a skill, it was to be maniacally focused on the things that needed to get done, right? Sort those big rocks that you talk about, right? Move the big rocks.
Yes.
And you had a clear understanding of what those things and metrics were to drive what you wanted to try to accomplish. And that's true, by the way, whether you're an originator, branch manager, a regional manager, a CEO. It's no different. It's just scale. It's just, enormity of the scale if you're sitting on the top of a company and you don't have anybody to talk to.
I think I'm I've talked to thousands of lenders now across the United States, and I'm coming to realize that the number one reason why us lenders, real estate agents, people in general don't hit their goals is because we keep changing the script on ourselves. We keep changing that. Now, I read somewhere that like 38% of the world writes down their goals. A big chunk of them wrote them down, but can't find where they wrote it down. Another big chunk wrote them down, but they don't read them every day. 1% reads them every single day, and they make sure they don't veer from the script. I am seeing so many of my students, I have to bring them back on track. They said, you know what, I'm going to do this week. And then they changed their mind. I'm going to do this week. I even had an opportunity from my office and I was about to change the script on myself. I'll tell you guys a quick story. Me and my friend were sitting on a Friday drinking wine in our office. And I said, what about the place next door? That would be awesome for my podcast room, for me to do trainings, for me to host live events. And she said, oh, that company, they've been there 10, 15 years. So I doubt they're going to be moving. She called for me on that next Monday morning. The property manager said, no, they've been there forever. So, no notice. Within 2 hours, the place called her back and said, your friend, the universe has her back because they're moving. They just gave their notice. I'm not even going to show it to anybody else except for your friend because this is just like universal alignment. So I asked for that. That was my goal, to have a brick and mortar place that I can do X, Y, and Z. I started changing the script on myself. What if I can't do that? What if I'm not successful? How much is it going to cost to decorate it? How long of the lease? Oh my God. And I started spinning out and I almost changed the script on myself. So I had to be really clear. I want this office. This is what I'm going to use it for. This is how I'm going to make an impact. This is how I'm going to have a local reach, a massive reach. And I see my students all the time. They decide that this is the way they want to go, and then they change their mind. You can't get anywhere if you're just dabbling in everything and changing the script. Would you agree?
Totally agree. And secondly, Part of the reason people change the script, to use your vocabulary, is life gets in the way. And they can rationalize why something else is now more important. Something else is taking priority. And look, there are things in life that are more important than what you or I do for a living, right? There's no doubt. But those are very few things. But if you then prioritize 50 other things that are really not as important, and you let those things flip in front of your face constantly, right? It's very easy to get distracted. It's very easy to rationalize why I can't, or I shouldn't, or I'll get to that next week, or I'll put it off. Look, there's a lot in my life that I've prioritized away that I probably shouldn't have, but getting the big things done and moving the big rocks was generally probably one of my skill sets in life through the process. And I probably have to apologize to other people in my life that, I was too focused in this area or that area. I apologize to myself all the time from a health standpoint, but, I focus better on that later in life. But everybody wants to go to heaven. Nobody wants to die.
Yeah. And those people also need to adapt. So as we wrap up, can you tell me your T-Rex snippet? Because I absolutely love it. And I think about it like almost as much I think of human beings.
I have to trademark two things. One is the T-Rex story, and the other is this concept that I've been talking about, a lot of public speaking that I've been doing at different conferences around the idea of planning your business by looking out the windshield, not the rearview mirror, right? Looking at what have I done in the past? How has it worked over the last couple of years? What's my history tell me? Look out your windshield and find out how your referral sources are doing in their business. That will very much predict how you're going to do in your business on a go-forward basis, right? And mortgage companies all over the country are missing that fact. They're not doing that kind of analytic. They're using a historical approach, and the history doesn't matter right now. Maybe other years it does. Right now it doesn't. T-Rex. So
love it.
I've often used my T-Rex metaphor to kind of explain to people how to think about the future. And let me just add one little adjunct to it here at the beginning. I heard somebody suggest to me, a couple of weeks ago, I just got interviewed on another podcast, and I brought this up, that if an originator, let's take our business, a salesperson in our business, let's say you've got, 6 referral sources. They've been feeding you pretty well. You've done well. And the person suggested as a coaching approach to say, what if all 6 of those referral sources went away tomorrow? What would you do? What steps would you take to rebuild your business? What data would you look at? Would you try to go find the realtors who are actually selling real estate today? Or would you just randomly go out in the market and call on anybody who had a realtor on their card, little R, and assume it's all going to work out, right? Would you be more defined? Would you have a plan? Would you work harder? Would you work on Saturdays? Would you go to open houses? Would you do digital marketing? Would you improve your social media presence? What are those things you would do to rebuild your business tomorrow?
Yes.
Make a list and start tomorrow, even while you still have your 6 or 7 referral sources. What's the worst thing that happens? You double, maybe triple your business. Maybe you do as much business as you did last year, but through more referral sources, which you've been able to maintain because you broadened the top of your funnel, right, in the process. But do it tomorrow. Why would you wait until those referral sources went away? And people are like, you get locked in, you get comfortable, I know my players. I've been with this group for 20 years and they've been feeding me. Well, realtors have been around for 20 years are likely about to retire. This commission lawsuit thing is going to affect a lot of people. There's a whole bunch going on. So your business is not as stable as you think it is. So along those lines comes T-Rex. So I don't have the slide behind me. You have the slide somewhere.
Yes,
I have a slide. Somebody gives speeches that has T-Rex coming out of the screen with these big claws. And why do I use T-Rex? Because I think about it in terms of market dominance, market share. And so if you think about it, T-Rex, right, the dinosaur, most paleontologists will tell you they roamed the earth for about 300 million years, and they were the top of the food chain. So they went where they wanted to go. They ate what they wanted to eat. They made little T-Rexes. If somebody from corporate showed up, they ate them. Nobody gave them any interference. They dominated the world for 300 million years. The analogy being they had number 1 market share for 300 million years. Have you seen one lately?
No.
I generally do this in front of a room with 300 top originators at a President's Club or Circle of Excellence event or whatever. And people haven't seen one lately. Why do you think that is? Well, they went extinct. Why do you think that is? Well, most paleontologists will tell you that the T-Rex used to eat the animals that were the leaf eaters, right? The folks that ate leaves and bushes and that kind of stuff. That's what T-Rex fed on because they were slow. You could catch them. He had short arms, so, you had to get in quickly. Something happened in the world. They think it was a comet, hit the world, snuffed out the sunlight for a couple of years. The leaves died. The leaf eaters starved to death and died. And T-Rex died because he had nothing to eat. But more importantly, he died because he had the brain the size of a walnut. And he was not adaptive to the change in his environment. He couldn't adapt to the change. And so the question I have for everybody in the room, or for your audience here, do you think much has changed in our business in the last 5 years, the last 10 years, or more importantly, the next 5 or 10 years? And if you're going to be successful in this business over the next 5 or 10 years, I will tell you, if you take nothing out of this talk, change is going to accelerate, not slow down. You're going to have competitors you can't even imagine. They don't exist today. They're going to be competitors in the future coming after your business in unique, Amazon wanted to get in the mortgage business. Think of leveraging that platform, right? The process, right? Walmart wants to get in the mortgage business. They already are a little bit. They just have kind of screwed up the execution. But companies like that eventually get it right. So assume massive, continuous change. And do you think that if you don't change and everything in your environment changes, that's how entities go extinct? And so my real question to you as an originator are you simply T-Rex in search of a tar pit to fall into? And if you're not, and you think and you buy this concept of constant renewal of your business, the 10 bean story, right? Constant renewal of your business, constantly looking to broaden the top of your funnel, digital marketing like you teach, maintaining your existing clients, adding other opportunities to clients to to your mix. Unless you're constantly evolving, unless you constantly understand the new technologies, I talk to originators all the time who tell me, yeah, I'm not really a computer guy. What? Do you think millennials want to interact with you on something other than their phone, right? They want to be able to communicate. A millennial will return an email maybe in 3 days, a text message in about 3 minutes. You want to communicate, you have to communicate the way they want to communicate. Are you evolving? Are you evolving, or are you a T-Rex in search of a tar pit? Tar pits, that old tar pit thing doesn't work out long term.
That's a mic drop on that story, because it is so true. And by the way, maybe I'm a millennial. I am in my mind, maybe because I don't return emails after 3 days. I text messages, my team checks my email, but hey, you know what? This is the way of the world, is adapting and changing. Everything that you just said is what is so needed for us as lenders, for us as, in the world and in real estate. But speaking directly to lenders, we've got to find ways. I always used to joke of my partner, Bobby. He owns 2 martial arts schools. He doesn't call the parents and see if they want to have coffee to see if they'll enroll the students. Where did we get so down that path of go hound realtors, go have coffee with them? Yes, it's relationship based, of course, but video, we have social media. We can make massive impact and share our authentic message with the world on social media, but people cannot adapt and figure out how to get good at technology, good enough, do a video, upload it on a teleprompter.
And by the way, if you take that approach, social media, and you get the buyer, 87% of buyers in America today have a realtor or a home builder hooked to them. Swim upstream, right? However you get the lead, however you get to the buyer, the ability to leverage that out to other opportunities is unbelievable. So again, are you evolving your business? Are you thinking about growing your business? Are you asking yourself, what if my referral sources all got hit by a bus tomorrow?
Yes.
And went away? What would you do? Would you retire? Would you be done now? Would you starve? Whatever that list of things are, go do it tomorrow. Maybe better yet, do it today. Make one more phone call. Call on a referral source. Do a social media video. Post it. To your point, it doesn't have to be perfect. I'm an old guy. I did a video this morning to introduce my weekly newsletter, as I do now every week, right? Took me a little while to kind of figure out how to not use a teleprompter right in the process, because when I saw it, when I first did it, I can tell when people are reading from a teleprompter, because you can see their eyes move to read the teleprompter. So I stopped doing that. And frankly, I'm better, extemporaneous anyway. So I write, 5 bullet points down on a piece of paper, and then I talk to the camera, put it out, comes across much more authentic, And you don't get, the eyes going back and forth, which is really disorienting to somebody watching the video. And so, look, if I can do it, your audience can do it.
Hey, if I can do it, the audience can do it. Trust me. So this was someone who 5 years ago was saying, I hate video, can't do it. How do I create a YouTube? What do I do? How do I create a podcast? And I just did it one step at a time, right? I'll eat elephant one bite at a time. So that's what you and I are doing. And that's why we're still in the game, right? I'm not going anywhere. This is all I know to do. So we're in it for the long run, right?
Exactly.
Well, Brian, thank you so much for your time. Always so valuable. I love your T-Rex story almost as much as I love the 10 beans, but we'll tell that on the next one. And I appreciate you. Thank you all for listening. Don't change the script on your goals, on your life, on your business plan. Stick with it. Read your goals every day. Don't become a T-Rex. Keep adapting and tell yourself better stories and you're going to win. So thank you. Thank you, Brian.
Thank you. Take care, everybody.
Look, every time, just to wrap up, every time I have access to Brian in that kind of one-on-one, it's like you're talking to a genius in the real estate and mortgage industry. We had dinner a while back, and the things that he knows, the experiences that he has had, is just a dream to be able to sit and have that time. So listen to the words that he says, not becoming the T-Rex, focusing on things, not letting life get in the way of our dreams, our business, our goals, and really working on business planning. He says in August, I was doing it in December. You know what? I think I'm going to August after listening to that, but paying attention to working on that 12-week year, right? By the time you start your goals in January, you're tired from New Year's, you're still putting away maybe Christmas presents, taking down the decorations. Before you know it, it's January 31st. Before you know it, it's Valentine's Day. If you set your goals to have your whole year's plan done by March 31st, it's the best thing you can do for your life and your career and your sanity, right? So open up time for creative space. Open up ways to not become the T-Rex, to open yourself up to change. Staying open-minded is so important during this time. So I hope that Brian and myself, that this episode helped you in some small or some big way. Listen to it again. Bob Proctor always talks about, he reads the pages of Think and Grow Rich, 1 page a day, his whole life. So he's passed away this year in 2023, but up until the end of his life, he read 1 page of Think and Grow Rich, the same book, for years and years and years. So go back, listen to it. I guarantee you'll catch things, or things will hit you differently that maybe you didn't catch the first time. So share this episode with a friend. Comment if you're watching this on YouTube. I can't wait to see you on the next episode. And hopefully, I know that Brian made an impact on something in your life and in your business today. So thanks again for listening. I will see you on the next one.